UK house prices are about to explode upward, and it looks like good news on the surface. But wait until you hear what's really driving this surge, because it's not what you think, and the consequences could reshape the entire property market as we know it. Mortgage rates are tumbling faster than anyone predicted just months ago. The average 2-year fixed rate has dropped below 4% for the first time since early 2023. And 5-year fixes are even cheaper, sitting at 3.7%. Lenders are practically throwing deals at buyers, with some offering rates as low as 3.5% for those with hefty deposits. It's a complete 180 from the chaos we saw in 2022, when Liz Truss's mini-budget sent rates soaring past 6% and caused absolute pandemonium in the market. Banks are now in a price war, competing aggressively for customers, and that means borrowing has suddenly become affordable again for millions of people who were completely priced out just a year ago. This drop in rates is already lighting a fire under buyer demand. Rightmove reported a 20% jump in inquiries compared to the same period last year, and viewings are up across the board. Estate agents are reporting that properties in desirable areas are receiving multiple offers within days of listing, and some are even going to sealed bids again, something we haven't seen consistently since the pandemic boom. First-time buyers who had given up hope are suddenly back in the game, running their numbers and realising they can actually afford to get on the ladder now. The momentum is building rapidly, and all the major forecasters from Savills to Knight Frank are revising their predictions upward, with some now expecting house prices to rise by up to 4% this year alone. If you want to stay ahead of every twist and turn in the UK property market, then hit that subscribe button right now and smash the like button so you never miss an update from Property Reporter, where we bring you the latest economy, housing and property news before anyone else. But here's where things get interesting, because this price surge isn't being driven by a strong economy or rising wages or even population growth. It's being fueled almost entirely by one thing, and that's the assumption that the Bank of England will keep cutting interest rates throughout 2025. Markets are pricing in at least 3 more cuts this year, which would bring the base rate down to around 3.25% by December. Every economist and every analyst and every property expert is baking these cuts into their forecasts and saying that cheaper borrowing will keep pushing prices higher. The entire rally is built on this expectation, and everyone from buyers to lenders to developers is acting as if it's already a done deal. The problem is that the Bank of England is starting to sound a lot less confident about those cuts than the market seems to think. Inflation has been stickier than expected, creeping back up in recent months rather than continuing its steady decline. Core inflation, which strips out volatile items like energy and food, is sitting at 3.2%, still well above the bank's 2% target. Wage growth remains elevated at around 5%, and that's feeding into service sector inflation, which is proving incredibly difficult to bring down. Several members of the Monetary Policy Committee have recently given speeches warning that cutting rates too quickly could reignite inflationary pressures and undo all the painful progress made over the past 2 years. The market is expecting dovish policy, but the bank is sounding increasingly cautious. Then there's the government's own policies, which are making the bank's job even harder. Rachel Reeves announced massive spending increases in the last budget, including a substantial rise in public sector wages and significant infrastructure investment. While this might boost growth in the long term, it also adds fuel to an economy that's already running hotter than expected. Employer national insurance contributions are going up, which many businesses have said will be passed on through higher prices. The Office for Budget Responsibility warned that these measures could add 0.5 percentage point to inflation over the next couple of years. The Bank of England can't ignore this, and if the government is stimulating the economy through spending, then the central bank has less room to stimulate it through rate cuts without risking a return to high inflation. It's a direct conflict between fiscal and monetary policy, and something has to give. Meanwhile, the global picture is getting more complicated by the day. Donald Trump is back in the White House, and he's already announced sweeping tariffs on imports from China and the European Union. These tariffs will likely push up costs for goods globally, and the UK won't be immune. If inflation starts ticking up internationally, central banks everywhere will have to think twice about cutting rates aggressively. The Federal Reserve in the US has already signalled it's in no rush to cut further, and the European Central Bank is taking a more cautious approach than previously indicated. If the Bank of England cuts rates while other major central banks hold steady, the pound could weaken significantly, making imports more expensive and adding to domestic inflation. It's a delicate balancing act, and the external pressures are mounting. So what happens if the Bank of England doesn't deliver those expected rate cuts? Or worse, what if it has to pause or even reverse course and start hiking again? The impact on the property market would be immediate and severe. Mortgage rates would shoot back up, potentially even higher than they were in 2022, because markets would panic about the inflation outlook. Buyers who stretched themselves based on current rates would suddenly find themselves unable to afford their mortgages, and many would pull out of transactions. The surge in demand we're seeing right now would evaporate overnight, and prices would stall or even start falling, as sellers are forced to drop asking prices to attract buyers who can no longer borrow as much. The whole rally would collapse, and anyone who bought at the top expecting further gains would find themselves underwater. This isn't just speculation either, because we've seen this exact pattern play out before. In 2022, the market was flying high on cheap pandemic-era mortgages, and then rates spiked and everything fell apart within weeks. Transactions dropped by nearly 30% year-on-year, and house prices fell for several consecutive months, wiping out gains made during the boom. Thousands of buyers pulled out of purchases, and sellers who needed to move were forced to accept significantly lower offers. The only difference now is that the market is even more sensitive to rate changes because prices are so much higher relative to incomes. The average house costs nearly 9 times the average salary in many parts of the country, which means even small changes in borrowing costs have a huge impact on affordability. Estate agents are already noting a strange dynamic where sellers are pricing properties as if rate cuts are guaranteed, while buyers are starting to hesitate, sensing that something might not add up. There's a growing divide between asking prices and actual sale prices, with many properties sitting on the market longer than expected, despite the apparent surge in demand. Some buyers are getting cold feet after running the numbers and realizing that if rates don't fall as expected, they'll be locked into unaffordable monthly payments. Others are waiting on the sidelines, hoping that if the Bank of England disappoints, prices will come back down and they'll get a better deal. It's creating a tense standoff, and the longer it goes on, the more fragile the market becomes. Then there's the issue of supply, which nobody seems to be talking about. House builders have ramped up construction based on the expectation of strong demand, but if that demand evaporates, they'll be left with unsold inventory and mounting debt. Several major developers have already warned that rising costs and planning delays are squeezing margins, and if sales slow down, some could face serious financial trouble. A wave of distressed sales from builders needing to offload stock quickly would flood the market with new supply, just as demand is falling, and that would put even more downward pressure on prices. It happened in 2008 during the financial crisis when several major house builders nearly went bust, and it could happen again if conditions deteriorate rapidly. Buy-to-let landlords are also getting squeezed from multiple directions. The government has increased stamp duty surcharges on additional properties, raised capital gains tax on property sales, and brought in stricter energy efficiency requirements that will cost thousands of pounds per property to meet. Mortgage interest relief has been slashed, and many landlords are finding that rental income no longer covers their costs, especially if mortgage rates rise again. A growing number are choosing to sell up and exit the market altogether, and this wave of landlord sales is adding to supply just as buyer demand becomes uncertain. If enough landlords decide to offload properties at the same time, it could overwhelm the market and push prices down significantly in certain areas. Renters aren't benefiting from any of this either, because even as some landlords exit, the market rents continue to climb. The reduction in rental supply is outpacing any decrease in demand, and tenants are facing bidding wars and rent increases of 10% or more year on year. Many renters were hoping that falling house prices would eventually make buying more affordable, but if wages aren't keeping up and mortgage rates stay elevated or start rising again, they'll remain stuck in expensive rental properties with no way out. It's a vicious cycle where neither buyers nor renters can win, and the only people benefiting are those who already own property outright. First-time buyers are in an especially precarious position. They're being told now is the time to jump in before prices rise further, but they're also being warned that if the economic outlook shifts, they could end up trapped in negative equity. Many are borrowing at the absolute limit of what they can afford, leaving no buffer for unexpected rate rises or income shocks. If someone loses their job or has their hours cut or faces a major expense, they could quickly fall behind on mortgage payments and risk repossession. The stress tests that lenders apply are supposed to protect against this, but they're based on assumptions that might not hold up if inflation stays high and rates don't fall as expected. It's a huge gamble for young buyers who have their entire financial future riding on these decisions. Older homeowners who have benefited from decades of price growth are increasingly looking to downsize and release equity, but they're finding the market isn't as liquid as they hoped. Selling a large family home in the current climate can take months, especially if it's priced based on outdated valuations and the costs of moving, including stamp duty, estate agent fees, and legal costs, are eye-watering. Many are choosing to stay put rather than deal with the hassle and uncertainty, and that's reducing the supply of larger homes just as families are looking to trade up. The lack of movement at the top of the market creates a logjam all the way down the chain, and it's one reason why transaction volumes remain well below historic averages despite all the talk of a price surge. Regional differences are also becoming more pronounced. London and the South East, where prices are highest and affordability is worst, are seeing much weaker demand than the rest of the country. Buyers in these areas are stretched to breaking point, and even small rate increases would price out a significant chunk of the market. Meanwhile, northern cities and towns where prices are lower relative to incomes are seeing stronger demand and more robust price growth. This regional divergence could widen further if the economic outlook deteriorates, because expensive areas have much further to fall when confidence evaporates. We could end up with a deeply fragmented market where some regions boom while others bust, and that makes national averages almost meaningless. Ultimately, the dark twist in this story is that the entire property market is being propped up by a house of cards built on expectations that might not materialise. Buyer confidence, seller pricing, lender appetite, and even government policy are all predicated on the belief that borrowing will keep getting cheaper. But if inflation proves stubborn, if global economic conditions worsen, if the government's spending plans backfire, or if the Bank of England simply decides it can't risk cutting rates further, then the whole structure comes crashing down. The surge in house prices everyone is predicting and banking on could turn into a slump faster than anyone thinks possible. There's also the psychological element to consider. Market sentiment can shift incredibly quickly, especially in property where transactions take months to complete. If buyers start to sense that prices might fall, they'll pull back immediately, waiting for a better deal, and that creates a self-fulfilling prophecy. Sellers will panic and drop prices to secure sales before the market deteriorates further, and before you know it, the narrative has flipped from surging prices to falling prices. We saw exactly this dynamic in 2022, and there's no reason it couldn't happen again, especially given how fragile confidence is right now. Some experts are quietly warning that we might be heading for a repeat of the boom-bust cycles that have plagued UK property for decades. Prices surge on cheap credit, then crash when rates rise and affordability collapses. Then the cycle starts again. Each time the peaks get higher and the busts get more painful, and the underlying issue of insufficient supply relative to demand never gets solved. The government talks about building more homes, but planning restrictions, NIMBYism and lack of infrastructure investment mean progress is glacially slow. Without a fundamental fix to the supply problem, the market will continue lurching from crisis to crisis, driven by short-term changes in borrowing costs rather than sustainable fundamentals. Foreign investment is another wildcard. London in particular has long attracted wealthy overseas buyers looking for safe haven assets, but recent tax changes and geopolitical instability have made UK property less attractive. Russian oligarchs, Chinese investors, and Middle Eastern buyers who once drove demand at the top end of the market have largely pulled back, and that's left a glut of luxury properties sitting unsold. If this trend continues, it could drag down prices at the high end and create a ripple effect throughout the market. On the other hand, if global instability worsens, the UK could once again become a destination for flight capital, and that would support prices in prime central London, even if the rest of the country struggles. The construction industry is also facing a crisis of its own, with material costs still elevated and skilled labour in short supply. Brexit reduced the pool of available workers, and many tradespeople left the industry during the pandemic and haven't returned. This means building new homes is slower and more expensive than it should be, and the government's house building targets look increasingly unachievable. Without significant new supply coming onto the market, prices will remain elevated in the long term, even if they dip in the short term due to affordability constraints. It's a structural problem that no amount of tinkering with interest rates can solve. Then there's the environmental angle, which is becoming impossible to ignore. New regulations requiring energy efficiency upgrades are adding costs for both landlords and homeowners, and properties with poor energy ratings are becoming harder to sell and mortgage. Buyers are increasingly factoring in the cost of retrofitting homes to meet new standards, and that's affecting valuations. Older properties in particular are seeing discounts applied because of the expense involved in bringing them up to code. As climate concerns grow and regulations tighten, this trend will only accelerate, and it adds another layer of uncertainty to an already complex market. Political instability is yet another risk factor. The current government has a large majority, but public dissatisfaction is growing over the cost of living, housing affordability, and economic stagnation. If there's a major policy shift or a change in government, it could completely alter the property landscape. Labour has talked about reforming planning laws, increasing social housing, and introducing rent controls, all of which would have profound effects on the market. Investors and developers are watching closely, and any hint of radical change could cause them to pull back, which would reduce both supply and demand simultaneously. What's clear is that the narrative of surging house prices is far more fragile than the headlines suggest. Yes, mortgage rates have fallen, and yes, buyer demand has picked up, but the foundations are shaky and the risks are enormous. The entire rally depends on the Bank of England following through with rate cuts that are far from guaranteed, and if those cuts don't materialise or if they're reversed, the market could turn on a dime. Buyers who are stretching themselves now based on optimistic forecasts could find themselves in serious financial difficulty, and sellers who are holding out for higher prices might end up accepting much less than they hoped. For anyone thinking about entering the market right now, the message should be clear: proceed with extreme caution. Don't assume that rates will keep falling or that prices will keep rising, because the economic backdrop is far more uncertain than it appears. Make sure you have a buffer in your budget for rate increases, and don't borrow the absolute maximum you're offered. If you're selling, be realistic about pricing, because the market can shift quickly, and a property that sits unsold for months will only become harder to sell. And if you're renting and saving for a deposit, don't panic into buying just because you're being told prices are about to surge, because there's a very real possibility they could fall instead. The UK property market has always been a rollercoaster, but right now it feels like we're at the top of the climb, and nobody knows whether we're about to glide smoothly forward or plunge into a terrifying drop. The surge everyone is predicting might happen, but the dark twist is that it's built on assumptions that could crumble at any moment, and when they do, the consequences will be felt across the entire economy. This isn't just about house prices, it's about household debt, economic stability, and the financial futures of millions of people who are making the biggest decisions of their lives based on forecasts that might turn out to be completely wrong. The next few months will be critical, and anyone involved in property, whether as a buyer, seller, investor, or renter, needs to be paying very close attention, because what happens next could change everything.